You are listening to Mining Stock Education.
If you've never been in this sector, or even if you were here before, this is the most lucrative pricing this sector has ever offered if you're able to discard all the fake and lifestyle juniors that pollute at least the Canadian system, of which probably 50% need to just not exist. But that would still leave about 600 companies to pick and choose from.
Thanks for tuning in to Mining Stock Education. I am your host, Bill Powers, and a returning guest. Last appearance was about 4 years ago, John Kaiser of KaiserResearch.com. John, you've been at this for 40 years as an analyst and a mining stock newsletter writer. You focus on the smallest of the small. You bottom fish within the junior mining sector. So let's start off the conversation with you sharing, where do you see value in the junior mining sector right now?
Well, Bill, for the first time in at least in the last 30 years, I am seeing good to fair speculative value amongst the resource juniors, both in early exploration stage projects and in ounce or pound in the ground type projects. And in the case of the pound in the or ounce in the ground type projects, it's the fact that the market is not taking the price of gold seriously. There seems to be this assumption, it's just another price spike, like cobalt, like lithium, like silver, like gold itself. It's going to crap out back below $2,000. So I'm not getting sucked in this time. It's a cry wolf situation. And with the exploration juniors, you can see the potential size of the prize, and yet the valuation, it's skewed towards almost there's zero chance of it becoming reality. It's as though people started to believe Brent Cook's idea that 1 in 1,000 actually will turn out into be something. The odds are more like 1 in 50 to 1 in 100 after the company has upgraded it. So now it used to just be a game of figuring out which ones were the least overvalued companies. This was in the 90s. This was in the 2000s. And that began to change in the 2010s. But now this is actually the most, if you've never been in this sector, or even if you were here before, this is the most lucrative pricing this sector has ever offered if you're able to discard all the fake and lifestyle juniors that pollute at least the Canadian system, of which probably 50% need to just not exist. But that would still leave about 600 companies to pick and choose from, which is what the Australian system is like, where they've done a much better job of purging the lifestyle type companies and actually have a government that supports their junior resource sector, as opposed to Canada, which has done the opposite of supporting the resource junior sector.
So you apply a quantitative approach, or what you call a rational speculative model, the rational speculator. How have you tweaked that over, like, say, the last 4 years since you and I have last spoken?
Well, one of the things that, when we last did that show, I walked through the whole logic of, it's based on the net present value of a future outcome, discounted to the present using a certainty ladder where there's from 0.5% to 1% certainty at a grassroots stage, all the way to 90% to 100% when it's ready to go into production. If you use this certainty ladder and you come up with a quantification of the size of the prize, you can apply that percentage range. For example, at the target testing range stage, it's 1 to 2.5%. So if you're looking at $1 billion prize, that should be priced at anywhere from $10 million to $25 million in terms of the implied project value. And this was hard to get people to understand. And so what I've done is I've created graphics where I sort of pick an outcome like this, and I can either do a formal outcome visualization, or I just look at the sort of scale and nature and say, okay, this is a 500 million type potential outcome. And I back calculate what the fair value channel should be. But also, most importantly, I have sort of the ranges for the S-curve, also known as the Lassonde curve, which is this bizarre tendency in this market when a significant new discovery suddenly lurches onto the scene. It attracts a lot of eyeballs, and then there is massive speculation about how big the size of the prize could be, because until you've delineated the limits of a new discovery, it could become the biggest and best deposit in the world. Who knows, until you've done all that drilling. So during that discovery delineation stage, there's this uncanny ability of the market to price a project at what it eventually ends up being worth many years and tens of millions of dollars of feasibility demonstration work later. And of course, once you produce a resource estimate, it shifts into cost discovery, which is really boring. It's finding out all the things that wipe out the revenue side of the equation. And it's also getting greater certainty about the resource, going from inferred to indicated to proven and probable, and figuring out the metallurgy and the costs for all this. And so then you get the S-curve actually going beneath the fair value channel. And that's called the valley of the trough,
the orphan stage.
Yes, and the reason this happens is if the junior is still funding it, you have no idea what sort of dilution you're going to have to incur to push this thing across the permitted feasibility study line, and how long it's going to take, because permitting has become a nightmare in almost all jurisdictions, and so that's why. In the 2000s, in the China super cycle, that was the feasibility demonstration heyday for the sector, where the juniors finally discovered how to do this. And this became what attracted institutional capital with the higher real prices that the China super cycle created, plus the repricing of gold. These projects that had been found ages ago suddenly were in the money, acquired by bigger companies, and developed. But prices flatlined during the past decade. So this became a really tough slog because you couldn't beat the drums about, $1,300 gold is going to be $2,000 next year, because it actually didn't. Now we're in a new situation where you do have this. So from a visual perspective now, I'm making it more accessible for an investor to look at this project, see how the market is pricing it relative to the S-curve and the fair value curve channel, and then make their own decision. And the thing is, the outcome is something you can do your own homework on. You can scope the geophysical target. You can do your background research about analogs, and you can come up with your own number. It can be smaller. Like some newsletter writers were famous for making the outcome as small as possible. Others make them so extraordinarily big they're like insane. They don't exist. But by taking this certainty ladder and using it as a framework, this gives you the ability to focus on what is the size of the prize. And this has always been what's been missing from the earlier generations. People did not know how to do it. The boomers generally don't know how to do it. Even a lot of geologists, they don't seem to teach economic geology in college when they get their geology degree. So that's why there's a lot of these bumbling juniors. And when you ask them, well, what is the size of the prize you need in this place to have a mine? They have no idea. They can't sort of map out what it's supposed to look like and what it's going to cost. Well, the serious companies, they have people within their teams who know how to do that. They're doing it all the time. And that's what they use as a decision. Okay, no, this project's not going to make it. We move on. We have to write this off. We're generating a new project. To get the younger generations in here, we have to teach them how to do this quantification, and I'm providing the framework to help them do that.
So you have the visualized outcome, the size of the prize, but to determine the speculative value, or what you could say is the intrinsic value of an exploration project, you have to have the percentage of success, right? So how do you calculate that, John? As I've gone through the rational speculator model, is it more intuitive, even though you're trying to quantify it, just based on your 40 years of doing this, to where you can say, this is the percentage of probability of success that I'm going to apply to this?
Well, what I do is I take the ladder as a structural given, a rigid given. So there's 0.5% to 1%, grassroots, going to 1 to 2.5% at target testing, going to 2.5 to 5% at discovery delineation, and then 5 to 10%, and then higher up as you go through the economic studies, and the size of the prize becomes constrained. The more you know about it, the farther it moves along in the exploration development field. Now, for the size of the prize, you need to know the basic concept of length times width times thickness, and with some sort of geometry of the ore body multiplied by the specific gravity. Most people have no idea what specific gravity is. And you have to not be an American and use imperial numbers. You have to use metric metric numbers to do this. And all of a sudden you have a deposit. And then you have like your grades, and you have to know how to convert the grades into rock value. You know how to convert grams per ton into using the gold ounce price and say, okay, this portion is this and that. Then you need to apply stuff like, okay, well, this gets 90% recovery and so on. So that shows you what's going to come out on the output side, and you see what the revenue stream's going to be. Then you got to figure out the cost stuff. Well, okay, the deposit's 50 million tons. It's open pittable. We want it to last at least 10 years. Maybe 20 years, so you divide it by that. So 50 divided by 10 is 5 million tons, divided by 365. So you got about some 10,000 or whatever. Can't do the math in my head, but you end up with some sort of some ton per day type operation. Well, one of the nice things about all these technical reports that the companies have done over the past 15 years is you have cost numbers for different types of operations, CapEx, OpEx, and of course the older ones are all stale, but there's always new ones. And one of my favorite things to do is when there's a new technical report or PEA or whatever, I look at the current numbers and I look at what would be comparable projects. So when you don't even have the deposit yet, but you think it's going to be something like that. For example, I do this with the Blackwater project, which Artemis Gold acquired from New Gold. So they did a feasibility study back in, I think, 2021 or 2022. That project now has a $6 billion implied project value, and it's actually making money, even though the grades were quite low. So I went back to that technical report, escalated all the costs by 25% to sort of take care of the inflation in the last 4 years. And now I use a number like that for what Bob Dickinson is trying to do with this Quartz Mountain Maestro project. And he thinks he's got a Blackwater analog. He doesn't have the proof yet to it, but then the pricing of the stock is relatively low. It doesn't have a $6 billion valuation. And so I can see, okay, if they deliver a Blackwater analog, they've got the physical footprint to that, but do they have the grade? So now we're in this sort of target testing. They're not yet in what I call discovery delineation, because they haven't quite figured out what the proper geometry and controls are. But when they do, I'm primed to say, this is now going to go live. And this project potentially could then go into S-curve territory as the market starts saying, wow, this is starting to look like Blackwater. And of course, this is where the market stops being rational and becomes irrational, but who cares? If you're investing while the market's still rational about everything, you're able to make rewards that normally you only deserve to make 3 to 4 years down the road later. And that's the beauty of discovery exploration versus feasibility demonstration.
So why do you focus more on the speculative side of junior mining stocks versus the producers, small producers, or about to go into production? You just prefer like the thrill of the drill, or?
Well, no, it's like I'm a human being with who has to sleep 7-8 hours a day and actually have a life too, and so I can only look at stuff. There's a whole industry of 6-figure analysts who go through all the producers' numbers, build their models, follow it closely, know nothing about anything else. I can't compete with that. So trying to figure out what all the 5 projects of B2 Gold are going to be doing and all that, I have no time left for anything. And those markets are relatively efficient. When you move down the food chain to the earlier stage companies, massive inefficiency reigns because there's been a catastrophic loss of eyeballs for this sector. There's just not people watching anymore. And the ones that are left really, or newcomers, they don't understand how it works. So this is like a playground for people who understand what the numbers are, how the geology works, to go in there and start to assess this. Now, I do like the advanced ones. For example, my top pick right now is Vista Gold Corp, which picked up the Mount Todd project back in 2006 or some long time period. It was a disaster thing. They stuck with this. They sold off all their other optionality plays. It's now the only project they've left. They spent $110 million. They've just done a feasibility study for a smaller 15,000 ton per day scenario, which has a $425 million capex rather than the $1 billion one for the 50,000 ton per day. And I take the technical report numbers, construct my own discounted cash flow model, and I run it at all kinds of crazy prices. And, they always just do the 5% discount rate. I do it at the 10% discount rate too, because that's what the majors use when they want to acquire a company, not this 5% nonsense that the companies all use in their press releases. So yes, I look at those two. And right now we're in a special window because like this Mount Todd project's being priced at like about $120 million. But it's, if you run it at $3,300 gold, it's like worth $3 billion. And so if you're going to be, it's permitted, sort of ready to go. So that should be about 50 to 75% of that final value. So this should be trading 5 to 10 times the current level. Why isn't it? Well, there's all this nattering about, well, there was these problems before, and once there's a problem, it's always going to be a problem. Well, they spent a lot of money and time solving those problems, so I'm not worried about the technical risk. The problem is, who's going to buy them? Well, the big guys aren't going to buy yet because they're still buying each other. The mid-tiers aren't yet priced high enough, and they can't justify $1 billion capex because we saw the nightmares from the past decade where we had hideous capex explosion. And then there's the concern, well, we're just going to milk the gold price now. We're now getting this fantastic earnings periods for these gold producers where they're showing how much cash flow they have reaped as a result of gold going from, whatever, $1,900 in Feb 2024 to its current level of $3,300 to $3,400 in a period where the gain is monumental compared to the inflation that's happened in there. And we're going to see as these mid-tiers start getting a higher valuation, as they lose the stigma of being incompetent and always overpaying for everything and underestimating the capex and opex, and people start taking the price of gold seriously, that we've undergone a fundamental repricing. I mean, 1980 gold at $400 CPI adjusted, it should be $1,600 if all it did was reflect the standard inflation measure. Well, at the current price, it's up 110% in real terms. That's not as great as in 1980 when it went from $35 to $400. That was a 400% real gain, which is why gold was a pig for 20 years. That's why the mining industry mobilized, went nuts, found all these deposits, and harvested all this former $35 high-hanging fruit that became suddenly very low-hanging fruit. And we had a bear market for gold, despite all the fiat currency debasement crowd predicting its imminent rise. Well, we now have gold at $3,300, and that crowd seems to have gone very, very quiet about gold going to $5,000 to $10,000. And I personally believe, gold could spike into that range, but it'll probably settle back into the $3,000 to $5,000 range. And we're going to be in a new era where exploration projects become much more interesting. The Vista Golds will be acquired. And a lot of these juniors that, kind of did a lot of work during the 2010s, that the market is still ignoring, that have these like 0.5 to 0.8 gram per ton deposits with some sort of a metallurgical issue or so. At these prices of gold, those problems all go away. And these things are the money, provided the permitting obstacles can be overcome. But the fact that like an Endurance Gold with its Reliance project and its relatively low valuation for this orogenic gold system that could be a multi-million ounce Braylorn clone if they ever get enough money into it, this can go from 20 cents to $4 to $5. I mean, that's, 20 times gains. And that could happen very rapidly if a drill hole gets into that sweet spot. Remember, Western Silver back in the 2000s had that Penasquito project or something like that. It was this boring silver thing. And it wasn't until they actually drilled into the guts of it and hit the gold-enriched core that this thing went from sort of this boring 50 cents to dollar stock to, I think it was a takeout at $30, where it disappeared. And this all happened very quickly. We haven't seen that sort of stuff in a long time, but if we get the cash going into this sector, and funding has been a big headache for these juniors, this is where the 5, 10, 20 baggers become possible. And that is, I'd like to see more of. I like to have my people into those ones, and that will also attract new audiences because not everybody's going to make one of those at the same time, but we have had a winnowing of the sector. Yes, there's still 1,100 resource juniors on the TSX Venture Exchange, but only about 450 of those have more than zero working capital. There's like 45% that have negative working capital, a total about $2.7 billion that's never going to be paid back. So you focus on the 450 or so that have more than $500,000 and teams that, don't waste money on ridiculous marketing programs and put the money in the ground to upgrade targets. So that's why I like the exploration, the discovery exploration sector, because the gains are extraordinary and it's an underfollowed, underwatched space.
That makes sense. And Rick Rule has said on my show, I think in 2017, he called it a knowledge arbitrage, that if you know what to look for, that you can take advantage of the knowledge arbitrage. Well, one question on the Mount Todd project there in Australia with Vista Gold. Vista Gold was a 2018 show sponsor way back when I actually featured Vista Gold. And when I would talk to people about Vista Gold, obviously this was many years ago at this point, but people would always say, oh, that project has fatal flaws, or don't they have this going? Oh, yeah, well, it may have a big resource, but it'll never be a mine. So do you think that mentality or that perspective overlaid over that company and that project has obviously caused people to stay away? But you're saying the knowledge arbitrage that you're taking advantage of is, I think that they're wrong and that this thing is going to be a mine based on my due diligence.
Well, first, the larger tonnage scenario, 50,000 ton per day, is like based on 0.77 gram per ton. And nobody wants to spend $1 billion to put a deposit below 1 gram per ton into production yet. And it has a very high work index, which means it costs a lot more energy to crush and grind the rock. And this was a problem the earlier operators, Pegasus and so on, never really figured out. There was complexities in the deposit that had a copper component, which really messed up the flow sheet. They now understand where that is. They can remove that and stockpile that and not have it come up the flow sheet. And they've had their eyes wide open about these problems. Now, back in 2018, the project was worthless. It was like marginal. The IRR was weak. The NPV, wasn't as good as the capex. Even the 2024, which they did at 1850 base case price, it really only cleared the hurdles for NPV, matching or exceeding capex at the 5% level. It failed at the 10% level. So really, it was a dot. But this is where nothing has really changed about the fundamentals, but the price of gold has. And that's what's strange. Now people don't know how to run these models, and the companies, I'm starting to see companies are actually plugging in $3,000, $3,300 gold to show what the NPV and IRR are at those prices, even though, the rules are you're supposed to use 3-year trailing average or some stupid industry consensus. And the industry seems to think like $2,200 gold is the consensus. I mean, Perpetua Gold for its Stibnite project used some ridiculous $2,200 gold as their base case price. And of course, the thing barely makes clears the development hurdles, and then the stock tanks and all these predatory class action lawyers then start suing. Oh yeah, the feasibility study, you misled everybody. Yeah, well, if you use a stupid price like $2,200 instead of like $3,000, yeah, it's going to look bad and the stock's going to go down. Yeah, this knowledge arbitrage, I call it like market inefficiency. There is a lot of it with regard to the resource junior space right now.
Do you think there are better opportunities in the resource juniors in critical metals, even more than precious metals?
Critical, I was very much into the lithium cycle from 2022 until it sort of crashed and burned in 2023. If electric vehicles are going to continue to flourish, and they may not in the United States, but they will in the rest of the world, the amount of lithium required to make that happen, barring some sort of miracle in direct lithium extraction from oil brine fields, type of innovation development, you need to develop a lot of these pegmatite deposits, like increase production sixfold from current levels after it's increased monumentally in the past seven years. But you need $10 a pound lithium carbonate for this to be reality. It's $4 a pound right now because you have the stop and start lurching type cycle where you suddenly have the EV demand go up and and it overshoots the lithium supplies, and the lithium price goes to a stupid price at $35 a pound. At that price, almost every pegmatite was in the money. It was like ridiculous. So I was warning everybody, no, you got to go for the higher grade ones. You got to, because 10 to 15 bucks is going to be the new long-term reality. But now you have this situation where, Trump's got a war against anything to do with the energy transition, and so sort of the enthusiasm stalled in the United States. So what do you do with like Patriot battery metals? So they're worth $3 billion at their base case price, but the actual price is only like 60% of that. So how do you play the sector? These things become bets on the future, the big picture future, the geopolitical future. Rare earths are another big deal. Like you saw this deal with MP Materials and the Pentagon. They're guaranteeing them twice the spot China price for neodymium and praseodymium. Aclara, with its ion absorption clay deposits in Brazil, which includes the headies, which Mountain Pass does not have, it's also using prices that are roughly double the actual price, because that's what anybody who is not going to be beholden to China, at the mercy of China's, machinations, is going to have to pay. So how do you play this critical metals game when China has this overwhelming advantage, and because it's a communist hybrid capitalist country, it can force production of raw materials down to a level where it's break even, and that makes all the other deposits elsewhere in the world, where you have to have the emission environmental control standards applied, but not in China, you can't compete against that. So they have developed this physical monopoly on metal production and, to a large degree, refining and processing, because a lot of stuff gets mined in other parts of the world and then shipped to China for processing. And then, of course, it's in China and they sell it to the rest of the world. So how do you're obviously not going to launch a junior in China or in any of these other screwed up parts of the global East world. How do you attract interest for these critical metal stories? So when to make it be in the money, the government has to guarantee a price above the global market. And this is where what Trump is doing, alienating the rest of the world, turning America into an island unto itself. The rest of the world will adapt and learn to trade around it, and they'll accept the China price for all these critical metals and make their stuff and not worry about it. And the United States is going to, be subsidizing these domestic sources. I think the critical metal space, although I've always been a big fan of it, I think it's tough right now, given the crappy global spot price that China has engineered for many of these critical metals.
You referenced that China doesn't have the emission standards we do. They don't have the environmental standards. So how would America be more competitive? What would you do differently than the current administration is doing to make American mining more competitive?
Robert Friedland had this interesting story back in 2020 or so. I don't know what happened to it, but he was going to use blockchain to create a chain of custody for metal sources. And this is when the public still cared about how clean the products were that you were buying. What was the carbon footprint? Were the materials sourced from areas where people were paid a real wage? Where the costs weren't dumped onto downstream victims? And so this was a way to document the source of the inputs. And you could end up having premium pricing for physical goods in America that the public could choose to buy. If they have a surplus of wealth, this can be their way of giving back. They buy the more expensive car that's where it's certified to be clean versus the import from China, which has all sort of dirty inputs. And it becomes an individual thing without punishing the lower income people. Like, you can't tell them to buy some $50,000 Tesla or whatever that's made in America, because they don't have the money. They want to buy the cheapo thing. But by allowing this market to bifurcate into a sort of clean, certified products versus that, you could allow the free market consumer to determine stuff. And then there would be an interest. For example, FPX Nickel, which has this nickel nickel project where it's potentially even has a zero carbon footprint when they get it into production because of the unique nature of the tailings to absorb carbon dioxide naturally. And this has attracted the interest of some Japanese companies, some mystery investors, because they saw this as a verifiable source of clean nickel. But now Indonesian dirty nickel fired by coal plants and pretty, nasty strip mining practices and all bankrolled by China, it has dropped the nickel price from below the 875 base case price needed to make the car work. It's now 650, 675, where none of these clean nickel projects work. But with the whole change in the Trump administration attitude, dirty is good, clean is bad. I would like to go back to this idea that there can be a difference between clean source products and dirty source products, and you celebrate the decisions by consumers to buy the cleaner product and pay the premium for the better product. That, however, is now all in reverse, and I don't know what will bring it back.
So with the car, obviously that was held up, and FPX is a former show sponsor, so I know that project relatively well. I've looked at that a lot. With the First Nations issue there, that kind of did damage to the share price. If you're in China, the government's going to say this is going to go forward no matter what. But here in North America, we allow the voices to rise up to challenge projects and sometimes stall projects for decades. So how would you deal with that?
Well, we're seeing like South America is becoming a very difficult place for juniors to get anything done. Africa is turning out to be off limits. The northern part of Africa, the Russians are in there. They're bankrolling military coups and then supporting the new regimes, and they're nationalizing whatever mines there are. So that's not really a place where juniors have any chance of doing anything. Mexico has its strange policies that have not yet been unwound, that AMLO started and Scheinbaum hasn't reversed. Even potentially a ban on open pit mining. I don't know where that stands now, but the whole title system has been upended, so that this is not a place for exploration type juniors to do anything. Australia's still a great place to do stuff, but that has its own ASX Australian Stock Exchange, and its culture of companies exploring that part of the world. So Canada and the United States are really the last frontiers for the resource juniors to do something. The United States has had this horrific NIMBY lobby, encouraging the U.S. Forest Service and the Bureau of Land Management, the BLM, to behave as though they're a health insurance company, to deny and delay everything, drag it on, which has, discouraged people because you have to wait a year to get a simple exploration permit because you have to do a raptor study that can only be done in this part of the season, and they don't tell you about it until the season has ended, type of thing. So you got to wait till next spring to do this. And in Canada, you have First Nations. And when Justin Trudeau signed on to UNDRIP, he betrayed Canada in a big way. Canada has lots of unexplored potential. Canada could supply the global West with a lot of raw materials. And back to the earlier question you mentioned, my talking point for the last few years has been this conflict between global East and global West will not resolve. It will only get worse. The Russia-China alliance, they're not going to become like us. And, well, America seems to want to become like China and Russia, and that's not going to be very good. But a couple years ago, I was hopeful that there would be this split in the economic trading zones, and then places like Canada could end up having an exploration boom, and even the United States, to find and develop these raw materials that you can't really get from China and Russia anymore because the conflict has escalated to a point where there's even like military exchanges happening. And but by handing control, final say over Canada's natural resource exploration and development destiny to 3% of the population based on a DNA characteristic, that has been like a massive sabotage. And in British Columbia, they have this new staking system, which basically has paralyzed staking of new ground. So last year there was a staking binge ahead of the change. And so now whatever exploration is left has to be done with the claims that have been staked. But everywhere, the First Nations stand up, put their hands out and sort of say, this is ancestral ground. We don't really want this disturbed in any way. But can you make it worth our while to have it be disturbed? So you have this extortion structure with no real resolution mechanism in place. So getting rid of UNDRIP would be the most productive thing Mark Carney could do now, and then sit down with First Nations and work out deals how what's really important to them gets respected, and we make them part of the solution, not a problem in the path of the solution. And that's why I'm a bit distressed about Canada as a place for the resource juniors. I'm more optimistic in the United States. We haven't seen it really yet on a very visible scale that the U.S. Forest Service and the BLM are relaxing their standards, just doing it properly, not obstructing on behalf of this army of anti-mining lawyers. But I think this is coming because with the path the United States is taking of alienating every other country in the world, it will have to take a much harder look at its own land and explore for stuff in its own ground. And that means going deeper because America has been prospected very well. If you're going to find anything, you're going to have to use geophysics to peer deeper. You're going to have to use subtle alteration studies like the geochemistry at the surface and use new models. Okay, well, how far from the guts of a system would this be? Does this have the breadth and depth to be the peripheries of a major system? Then you're going to have to drill holes, deep holes to test, to find the 3D geology. Rick Rule's old prospect generator model where he forbade companies from ever drilling any holes, it's obsolete now because none of these prospects are interesting until you add the third dimension. And this is, of course, good for the resource junior sector. My goal of eliminating half of the companies as fake lifestyle companies, let the serious half raise enough money so that they can drill those scout holes if there's low-hanging fruit there and they get lucky and spear it right away. Fabulous. Then you get the stock taking off immediately and they keep 100% of it and do the delineation drilling, spin out all the other assets and get bought out by a producer to develop it. But the farming out something just based on superficial evidence and some geophysical mumbo jumbo, the appetite for that isn't there yet. And so that's kind of the next frontier. Don't blow your brains out drilling dozens and dozens of holes seeking where the plum is. Do enough to create the geological context and let the deep-pocketed producers farm into these plays and spend that money and use their internal resources to decide, no, it's just not going to make it. And this is where all this new digitization technology, a lot of these AI methods of being able to look at this data in a computational way allows decisions to be made a lot more efficiently about when to keep going and when to say, no, this thing is just not matching the model that we're expecting. We know enough about the whole system. And one thing I would like to see develop is a culture of not royalty companies, but almost like public deposit banks, a new type of creature, which, if a junior finds a deposit that ends up being bought out for $500 million, that's great. Everybody makes money. A lot of that money gets recycled. But most of the time, it ends up not being worth developing. So what if these deposit banks then buy out the company for $50 million, and that gives some of the money back, and then they just store it? Because there may be a future coming where, say, fusion energy becomes a reality. Suddenly you have a 90% collapse in the cost of energy. So instead of the metal price going up to drag this low grade or this underground system into the money, you drag down the cost of mining it through a new energy revolution. Now that's still 10 years down the road, but China's working on fusion now because they have a lot of deposits that aren't worth developing. But if they develop fusion energy, they don't need to mine stuff in Africa or anywhere like that. They can just take these deposits that they already know exist and apply lower cost energy to extract them. So that would be good for the junior sector. Instead of this, it's either a world-class outcome or it's zero. That would be a nice change to have these types of entities out there acquiring the failures and at least partly rewarding the original backers, not the ones who bought at the top, but at least the ones who backed it in the beginning.
I've never heard that idea before. But John, I wanted to ask you about a presentation you did at Metals Investor Forum earlier this year. You were very candid and forthcoming and vulnerable regarding your newsletter writing business. You don't take money from any companies, so you're 100% subscriber supported, but your model's changed over the years. You've been at this decade. Would you mind sharing with my audience how you changed your model and why you changed your model?
In the 2000s, but before that, I was just sort of a stock picker and would come up with my 100 bottom fish list, and people loved it, and it was popular for a while. And in the 2000s, with digital technology, the internet, and all that becoming available, the game upped. One needed to be better at picking stuff. The old bottom fishing thing of buying them during that period when the insiders reloaded and had to wait a year before the paper was free trading, that changed with the 4-month hold period. So suddenly these things would suddenly explode and take off right away. So this idea, this tool for picking them, accumulating them, and just waiting for all that, the fun to start, that died. So it had to be one more of looking at the story, wondering which projects have potential to actually deliver the fundamental goods. So I developed a system of tracking all the companies, all the financials, and so have this giant search engine, both the corporate level and the project level. If I'm interested in advanced gold projects, I can quickly see everything that's available. And this was what the service became. And yes, I still had sort of the stock picks, the favorites, and the bottom fish collection on the side, but there was the search engine for do-it-yourselfers. Well, the audience that cared about the resource sector just kind of vanished. So both the ones that were interested in the bottom fish and favorites, that subscriber base shrank, and the other ones also vanished. So it was basically a business model that wasn't supporting itself. And the competition comes from all these fake newsletter writers who are all sponsored by companies. They're basically propaganda artists, not researchers. They kind of just figure out what the story is and regurgitate it. They can't be like me, where if I suddenly don't like a news release, I can just say, this is bad news. I'm not supporting this anymore. Or if management does something outrageous, I can just say, yeah, I'm not beholden to them because they paid me $5-10 a month or whatever to like the company. And a lot of these ones aren't even like paid newsletters. They're like free outfits. And their influence has diminished in the past couple of years because this bear market that began in 2012 had a rally in 2016, another one in 2020 ending pretty much in 2022. It's gotten really bad. So even when you pay some pumper to pump a stock, there's no eyeballs watching. Nobody cares. This has been what I call this catastrophic collapse of eyeballs. So even that is a waste of money. So I was ready to pack it in. I saw that Trump was elected in November. I said, okay, this is going to change things in unpredictable ways. It'll probably continue to support the price of gold. So I decided to stick it out for another year, but launch a new version, the Substack version, where the favorites, I post my sort of free comments, big picture comments, plus the restricted to the $100 a year or $10 a month audience about the company specific comments. And I'm using this rational speculation model to try and attract an audience that doesn't even know the sector exists and pull back some of the ones, the boomers who have kind of given up on it, but now are looking at this gold price and they're not seeing any action in the market yet to really reflect it. So thinking, why is that? And then I come up with explanations why, and they realize, well, those explanations are wrong. It's just a matter of time. And so now I've got something which basically, if you inflation adjust my $99 bottom fish list that I launched in late 1994 to the present, that should be $200. So this is $100. So I'm working to rebuild my audience to a 5,000-10,000 audience focused on this and teach people how to think intelligently, quantitatively about the resource sector. And once they get away from momentum gambling on Bitcoin and Tesla and all these other things and get back to fundamental value investing where they're doing a lot of thinking, where it's entertaining, where they're researching, where it's very similar to fantasy sports, where the season does stretch from 3/4 of a year, and where you're changing the makeup of your team all the time, just like your portfolio of juniors. It's fun. There's no limit as to like this knowledge arbitrage. You can do a lot of homework on the geology of stuff, a lot of learning. It's fun to be engaged in this resource junior sector. And I think there's going to come a point, don't know when, where people suddenly are disgusted by momentum gambling and go back to a more traditional fundamental gambling. Because if you're momentum trading, you're glued to the screen all day. Life is boring. I did that in the 80s and bit into the 90s while I was in the brokerage sector. The stock ticker was going there all the time. It was mesmerizing. It was a big, giant productivity black hole. Got nothing done. Had to turn the thing off to get stuff done. The way I do it now, I don't really watch the moment by moment, and sometimes not even the day by day. I find out what's the timeline for news, the milestones coming up. When it gets close, I start to check, is anything happening in the market to indicate cheating or anything like that? When I watch for the news release, I prime myself to understand what counts as good news, what counts as bad news, or what counts as entirely different news that requires a complete rethink. And that makes this whole game entertaining. People ask me, why don't you retire? I'm 65. I said, well, if I retire, I will probably pass away and succumb to dementia or something, because not doing this incredible and be engaged in this incredibly interesting and entertaining sector where you look at the project fundamentals, but also have to think about technology trends, geopolitical trends. This is what makes me tick.
I've heard that from a lot of people. They enjoy it. It's not just the money, but you actually enjoy what you do.
Yes.
Yeah. And so if listeners want to find out more, is it KaiserResearch.com? They should go there?
Yeah, so that's the expensive one, $450 a year. Well, to the end of this year, it stops being available. Those who are members at that price, the end of this year, get to renew at that level. But the new thing is Substack.KaiserResearch.com. That's the place where you can sign up free to be on the list, to get whatever I publish that's unrestricted. And if you can afford $10 a month, you can sign on and get the entire company specific one. I've just graduated a bottom fish to the favorites collection, which I will be doing publishing very shortly. And it's kind of revisiting the WITS 2.0 story that I was very fascinated by back in 2016, 2017. It's a mini version that was going on parallel at the time in Ontario, but it has now, all the missing pieces have fallen into place. And we're about 1 month away from finding out if they now have the key to demonstrating, confirming what they think the size of the prize is at this project.
All right, so I will link to both the Substack and your website in the show notes if listeners want to find out. John, really appreciate catching up with you, and thank you for your insights on today's show.
Thank you very much, Bill. It's been a pleasure.